All right, so the previous part was all about how to invest property under your name. We're going to talk about super, how that works, and I'm going to touch on super, self-managed super fund with a property as well. So I believe that the future is actually super. And super is our future. So people ask me, look, I don't know where to start with my super. And I say the first thing that you probably need to do, if let's say you don't want to buy an investment property, but you want to build up your super and you want to build up your super fast. And let's say you're working for an employer, you're on a $100,000 salary, your employer is putting that 9.5%, so that's $9,500 a year. That is not enough. Paul Keating, who created super the way it is right now, he said that we all need to put 20%. And right now our employer is putting 9.5%, and so we need to top up the difference. So let's say if, so how do we top it up? And one of the best strategies to top it up is actually to salary sacrifice. Salary sacrificing is saying to your employer, look, I'm on a $100,000 salary plus super. I want to sacrifice, say, $5,000 more into my super. Then your employer will drop your salary down to $95,000 and put that $5,000 directly into your super. Yeah, by doing that, you actually save tax. And what you save is $39 a week on $100 a week that you salary sacrifice super. Not bad. By putting that in, and I've worked this out for a 35-year-old on a $100,000 salary for the next 30 years, by the time they come to retire, the difference between someone who salary sacrifice and someone who doesn't is $157,000 in today's money, more in your bank, in your super account. It does make sense to salary sacrifice. Now, of course, this is based on assumptions that your super fund manager is not going to take off with the money. Nothing's going to happen to your super fund. And, with all these assumptions, with, investing in a balanced super portfolio in an average market. Yeah, so it does make sense that you could end up at age 65 instead of $400,000 super balance, that you could end up with $571,000. If, let's say, I don't want any headaches with anything except I just salary sacrifice. Does that make sense to you? Does that sound like a good idea to do even right now? Yeah, that's part of your forced savings, save extra money and reduce your tax at the same time. Yeah, one simple, easy way to do it. I'm just going to give you some super basics because people don't know what is happening with their super. While you are while you are working, you're classified as you are in what we call accumulation phase. That means you're accumulating your super money. You're building up your super money, whether you put money into your super or your employer puts the money in super. As the money comes into your super fund, the super contributions are taxed inside the super fund at 15%. That's why people wonder, why is my super not going up that fast? Because for every $100 that walks in there, your super fund manager will take $15 straight away out, save it in a tax account that they put aside, that they're going to save that money and pay the tax man at the end of the year. Yeah, on your behalf. If your super fund does have any capital gains, so your fund manager right now, whoever you're with, whether industry super fund or a public fund, they buy and sell within the market. They buy and sell shares. If your shares inside the super fund, it's all complicated, but they pool all the money and they start investing in the market. If they hold on those investments for more than 12 months, the capital gains tax your super fund will pay will be 10%. If they're buying and selling a lot, and I've seen some super funds do that silly thing, then your super fund will be paying 15% tax on that capital gain. So there is tax to pay while you are working in accumulation phase. Make sense? Now, when you become a pensioner and you retire, if you were 60 years old and retired, so you could choose under the super fund system to retire at age 60, and the moment you retire and you start taking money out of your super fund, what we call pension payments, you will pay zero tax on the income your super fund is making. You will pay zero tax on the pension payments that you will be taking out, and you will pay zero tax on the capital gains. Does that sound good when you're retired? It sounds good at retirement. It just doesn't sound good while you're accumulating, isn't it? But there's ways to reduce that, and we'll talk about that in a minute. Now, how much you can put into your super is the maximum contributions that the government allows. Up until 30th of June this year, you can put a total of $25,000 in your super fund, and that includes your employer 9.5% and any 9.5% and any salary sacrifice you want to add, or any super contributions you want to put into your super, which you can do now. So let's say you've got extra money, you go, let me send my super fund $1,000. You can claim that in your return, your tax return, as a personal taxable contribution, but there's some forms to complete to be able to do that. Yeah? Make sense? The good news, from 1 July 2021, the $25,000 limit is going to go to 27.5. Wow. Okay, now the other thing, so this is what we call concessional contribution. It's assessable, and you pay that 15% tax when it goes into your super fund. However, you can still put more than the $25,000 into your super fund, but that is not going to be taxable. We call it non-concessional contribution, and it's tax-free when you put it in. So let's say you get an inheritance and you go, look, I've got $500,000 from my family's inheritance. I don't know what to do with the money. I don't have a mortgage. You know, I want to put it somewhere safe. The best way to do it is to actually dump it in your super fund, but there's a limit. You either put $100,000 a year into that fund, or you put in one hit $300,000, and you gotta wait 3 more years before you put the next $300,000. From 1 July, that's gonna go up to $110,000 a year, or $330,000 every 3 years. This is good for people who want to, get an inheritance, or they're getting close to retirement. I don't see that done for anyone under the age of 55, actually. But most people will start doing that once they pay off their mortgage or they start getting inheritances. That is a big thing right now. Yeah? Make sense? Okay. You need to know where your super fund is. You know, I can't stress enough that you need to know that you've got the right address with your super fund. That if you've got more than 2 super funds, consolidate them. Go find My Super online and consolidate all your super funds in one, because if you have more than 2, that means you're paying 2 sets of fees. It doesn't make sense to do that. Consolidate, know where your investments. So read the statement. Where is my super fund right now being invested? Is it being invested in an ethical fund? You know, a lot of young people your age, they actually want to know that their money is being invested in the right places to safeguard, the next generation, right? You gotta also know whether you're conservative, you're a balanced fund, or a growth fund. And you will see that probably on page 3 of the statement. Go have a look. If you're under the age of 50, go for growth. Anyone over 50, start going balanced or conservative. Growth means you're investing in the market, you're taking the risk. It could be huge risk, but huge return. You want to build up your super as you go. You also have to look at if you have insurance. You've got life and TPD, total permanent disablement. Make sure you have some insurance inside your super. Your employer might give you income protection. I've seen income protection insurance in some people's super funds, and that is only for 2 years. So if you want to, cover that and make sure your income protection covers till age 65. The other thing is update your beneficiaries. If you're getting a divorce, like your husband or wife, and you want to give it to your girlfriend or mistress, make sure you write that on your, binding death nomination, because that will be contested, right? So you got to get the right people who will take your super fund if anything happens. Make sense? Okay. So I believe that if you want to take complete control of your super fund, there's nothing better than having your SMSF, which is self-managed super fund, which is basically you control. It's like having your own company. You have your, it's a trust structure, but you control the bank account, you control where you invest, and you know where the money is. Yeah, and you make the financial decisions. Before we talk about having a property in the super fund and what does that, how does that work, I'm just going to give you a short rundown of what you can and can't do with an SMSF. You can have up to 4 members registered with the tax office. There's talk about getting 6 members. They're still talking about it. It's been in the budget for 2 years ago, and they have not still passed it. But right now, it's 4 members registered under the ATO. That means maximum. That means husband, wife, 2 children can be in it. Husband, wife, brother, sister-in-law can be in it. That means 4 friends who are sharing the same house, who want to live together forever, they can go and be in it. So, you can add more people in there. You can buy with your super fund money rural land. The bank will lend you up to 50% value. You can buy car parks and rent them out, whether to your business or out to tenants, or to Wilson Parking. Wilson Parking do a lot of these. You can buy commercial office like this one, or retail shops. The bank will lend you up to 75% of the value of the investment. The super fund needs to come up with 25%, and I'll go through numbers with you. You can buy residential property, and the bank will lend you up to 80%. Sorry, not lend you, lend your super fund. Yeah. You can buy shares, manage funds, bonds, cryptocurrency, gold, silver, and anything you could think of that could increase the value of your investment, and that money will be safeguarded for your retirement if you can prove that it will. Yeah. What you can't do is once you get your money and roll over your super, you can't lend the money to yourself or to associates or anybody that you know. It's not lending. Like your super fund is not a bank for other people. You can't rent the property that you buy to family and friends. Don't ask me if the surname is different. The ATO will find out. You can't live in that property that you're going to buy in the super fund at retirement. And you can't take the money because you will end up having control of your self-managed super fund and your money. You can't just go, you know what, I couldn't pay the mortgage today. Let me take couple of grand out of my super fund and transfer it to pay my mortgage. You can't do that. Yeah. So no personal use. In order to set up the super fund and make it worthwhile for you and be compliant, you need that sweet spot, which is you gotta have $200,000 to start off with. That 200 could come from, as I mentioned, the 4 members. So it would be like 4 friends, 50,000 each in their super fund. They can come together, pool the money, and there's 200,000, and they can do wonders with that. Or husband and wife, there's 100,000. She's got 100, he's got 100. And husband, they can do that. Girlfriend, they can do that, right? Everybody is equal under the law, okay? So you can do that and make self-managed super fund investments worthwhile. Make sense? Okay, so how do you invest in a property inside your self-managed super fund? It's the same scenario. Your super fund, once you roll over your money, and we do this whole service, and we'll explain to you how we do that whole service. Once you get your money, the cash from your super fund, all you need to do is put a 20% deposit for a residential property, or 25% deposit for a commercial property, and the bank will lend the super fund the balance. Yeah? No mortgage insurance, nothing. Okay? And the bank will work out whether the super fund will get the loan based on two things: the rental income that the property will generate and the super contributions that you or all the members coming in, the up to 4 members super contributions coming in. Yeah? And then they will work out their formula whether they can lend 500,000 to the super fund, 700,000 to the super fund. All these calculations get worked out. Before we do anything for any client, we work out whether you're compliant to be able to set up. So can you make that 200 before we do anything? And then we go through the list of what we need to do for you and how much you can borrow, how much the super fund's got. This is all calculations that we help you out with. So with this scenario, we've done this countless times with clients. A $400,000 property, it used to be 30% deposit for residential. Now it's down to 20% deposit. So you could actually borrow 320, not 280. But it means your rental income from the property will come into the super fund bank account. Bless you. The super contributions coming in, husband and wife coming in, or, you know, husband, wife, all coming in, you know, friend. Yeah. All that money comes into the super fund. You made me laugh. Then when that money comes in, so let's say in this case, a $400,000 property, $21,000 rent a year, plus super contributions, that's over $35,000. That's about $3,000 a month coming into the super fund bank account to pay for things to service this loan, this property loan. Pay down the mortgage, pay the council rates, water rates, audit fees, accounting fees, the agent, and pay off this loan. I've never done any calculations with this kind of scenario with good contributions, not bad ones. Like, you know, you can't even get a property like this under $15,000 contributions. So you gotta top it up. You gotta put more super contributions in to be able to get the bank to approve it. The bank will not approve it if the income coming in is not good enough. And then you can pay down this loan over 20-year period. Yeah. So this is not a rich, get rich quick scheme, right? You can see it's like, you got to show up every day and work and, do all the stuff and commit to your career for at least minimum 20 years. But 20 years is not a long time. If you start at age 30, you could be retired by 55, but you're going to be committed from age 30 to be able to do that. Yeah. And for the 50-year-old, it's never too late. You could retire by 70. That's pretty good. Okay, so I'm just going to show you some numbers of what this means. So for a $400,000 property, 280 loan, principal interest with super fund loans, the interest rate is a little bit higher. So it's about 5% than the normal ones that you would get under your name. Apparently the banks think that super fund loans are a risk, but I don't think they are a risk. They're actually the opposite. It's just that the banks are trying to make more money out of it, to be honest. Yeah. So this also is a representation of summary of a massive Excel sheet that we go through and work the numbers for clients. The net rent for this property, it's actually making $400 rent. So this is net rent, profit or loss. It's actually the first year is a loss. It means the rental income less the expenses that you would have to pay, including the mortgage, is actually a small loss of $1,300. However, you still got your super contributions coming in. That means that $15K coming in will pay down most of the mortgage. So your loan balance starts from first day of year 1, 280. By the end of year 1, the loan balance goes down to 271. And I've shown you like a summary of what it will look like in 15 years. If you religiously do rent coming in, super coming in. The loan by year 15 will be 97. So it's gone down from 280 to 97. In this case, actually, the loan ends at year 18. Why? Remember when we talked about the super contributions get taxed at 15% when they go into your super fund? When you have a property inside your super fund, the taxes bugger all. So we've got clients who don't pay tax in their super fund, even though they've got the contributions coming in, because they get the tax deduction from the property. And it all gets, so this is the real rental loss. The difference between that one and that one is actually the depreciation on paper that we claim for them. And so the tax you would pay is the difference between the rental loss and the $15,000 contribution. That's the only tax you would pay on that difference. So you never pay tax on $15,000 when the money comes in. And when you pay the tax, it's only a year after when you lodge the super fund tax return. Not when you, in your case, when your super money is going to your current super fund, they grab the 15% out and they invest 85% of the money comes in. In this case, you're investing your 100% in as the contributions come in. That's why they wanted to shut it down. You get that? I see it every day. And all this Royal Commission and all this stuff, they're stopping you from taking control of your money, because in 20 or 30 years' time, the government actually doesn't have money to pay your pension. The social contract is broken. And even with this corona, with the borrowing they're doing, I don't know what kind of excuse they're going to give us and say, you got to take care of yourself. One of the things they're looking at is they're going to assess homeowners, whether it's applicable for them to get the pension or not. So if you're a homeowner and you worked all your life for 30 years, paid the tax, in your mind, you're thinking you're going to get the pension, because that's the social contract the government currently is doing. But in 30 years, the rules will be changed because actually the government doesn't have money. Then you will be drawing down on your home mortgage to live. You get me? And that's why they're approving reverse mortgages. You know what reverse mortgages is? It's, the old ladies in the North Shore are taking reverse mortgages because the $2,000 pension is not enough, right? They can't even live on bread and milk. By the time you pay the water rates, the council rates, and the bills, electricity, how much have you got left to eat, right? So they have to draw down off the equity of their home. Banks right now are providing it. Home Safe, there's a product called Home Safe. And that's the reason it's happening. The government can lend you money right now on your home if you're a pensioner. They're saying if you don't have enough money from the pension, then we will lend you money at whatever interest rate. Yeah? So that's why I'm passionate about this stuff. Yeah? For me, it's like I've looked at the numbers. I've done this stuff for so long, and I can see the value of it. Now, this does not work for everybody, but it will work for a lot of people that we are working with. And I will tell you, if this doesn't work for you, I will honestly tell you it's not going to work. Because at the end of the day, before we even set it up, we have to get approval that this structure it's going to be approved by our licensee. As a financial advisor, I have to get the approval for it. Yeah. So now, how do we set this up? Because I know we're going to go legal and we're going to go complicated right now, but I'm just going to give you the rundown of when you set up your self-managed super fund. How does this work if I want to buy a property and I borrow, blah, blah, blah. Okay. You got to have two entities. Okay. Which is what Shane wants to know. Okay. You currently have a self-managed super fund with a corporate trustee. This is how it gets done. A company, a shelf company, who acts as a trustee, does nothing else but be a trustee. It's just a company. Okay, no tax returns done. We just buy it from ASIC and get it sorted. A super fund, the super fund is where all the action is going to happen. And we set this up for the clients and get the super fund for them. If you don't want to borrow, so you say, look, I've got $500,000 in my super fund. I don't need to borrow. I don't want to borrow. I just want to invest my $500,000 and I want to take control of my super. We set up only this structure, a corporate trustee with a super fund structure. And you say, I don't want to borrow, and you run. The moment you say, I want to borrow and I want to buy property, you can actually borrow in the super fund and actually buy a share portfolio. Macquarie Bank will lend you that. Yeah? If you say, I want to borrow, so I have $500,000, but I want to borrow another $500,000, and my total investment will be $1 million, and I want to invest, whether in the share market or in property, we got to go with this structure, which is a combined structure. It's like a marriage, between two entities. This one is what we call the property trust. Because super funds cannot borrow by law, this is the convoluted way of setting up this legally to pass the ATO audit that super funds cannot borrow. And so when you buy the property, the property itself will be under the name of the property trust, not your super fund. But don't worry, you here and you here. It will be fine, okay? You're in control of all of these entities. It just looks from a legal perspective, from the legislation, it looks like there's two entities, but you're a director here and you're a director there. It's the same people. Once this structure is set up, then we have an agreement between the super fund and the property trust. And the agreement is this, that the beneficial owner is the super fund, always will be, right? Once the property itself, the loan is paid off, the property ownership will move from the trust to the super fund, and then we can shut this down. But as long as there's a mortgage, the property trust is set up in order to hold it in trust, okay? This structure was created by Macquarie Bank for the rich 20 years ago. They made a lot of money for the Eastern Suburbs guys, right? Investing with this structure in the share market. The ATO came in and said, no, we don't like this structure. You can't borrow. The Macquarie boys argued in the High Court and they won. And by their winning, they opened the floodgates for normal people like you and I, because this was being done in the offices of Macquarie Bank without us knowing. The legal team figured out a way to work around super fund law and have their clients borrow money and make more money. Can you believe that? And now it's available for everybody. So in the end, the ATO basically went like, okay, we accept the High Court decision. Macquarie Bank won, but these are the laws to be done for the rest of the population. Yeah? And that's the structure we've set up. When this structure got started, it was back in 2006. It was being sold by the lawyers for $15,000. Yeah? So the structure that we provide now, it's actually the prices have gone down dramatically. We went from, when we started doing this, from 12 to 6, and right now we're down to 5.5 that we can get it for, because lots of lawyers are involved in this stuff. So we work with lawyers to get loan agreements, the structures, 2 trustees, 2 super funds, blah, blah, blah. So in your case, Shane, it will be half of that for loan agreement, property trust, and a corporate trustee. He already got a super fund. Now, so this setup fee is one-off. You never pay it again. It's just to set up the structures, like you buy a company and you start your own business. However, every year that super fund is like a company. We got to do the accounts, the tax return, and get an auditor. We have an external auditor. We never do the audits in this office. So it's, someone who is not related to us. And we send the audit to them, because that auditor is approved by the tax office to manage. It was one of the deals that they'd done. How is the ATO going to, control the floodgates when they opened, which they did. So I think now we've got over 1 million self-managed super funds, and self-managed super funds are the fastest growing. Every time I go to a self-managed, SMSF Association seminar, there's always a representative from the ATO coming in to talk, because they can see the impact of self-managed super funds and the importance of people like us to safeguard people's retirement money, because that's safeguarding your retirement. Like, in order for us to get through an audit with the auditors, sometimes can be, challenging. We also can provide you with a property service, so we can refer you to people we know, whether it's off the plan properties or properties that are already ready to go and to buy. They're properties that I would invest in. I've actually invested in them. So with the setup, don't worry about how all that complication. I had actually a meeting this week with a client. They wanted to buy business premises for their business, and we went through the system, and they go, "Oh my God, this is so complicated." I said, "All you need to do is come in and sign. We give you the documents. You go to the bank, open the bank account. We roll over your money. We do the stuff. We give you the advice. We give you a statement of advice." So part of it is to give you a statement of advice where the money going to be invested. So we're going to write it down for the ATO to get approval on that. But all you need to do is just sign a few documents. You don't have to worry about anything. So I think that the average Aussie might need either 1 or 2 properties to be able to retire. $500,000 here, $500,000, 1 million to retire. And I've done calculations for clients all the time. Just get one under your name and one under the super, and have your own home. That one under your name is tax deductible, will not cost you much to run. And that one in the super fund, the rent and the super contributions will pay it off, right? And you tick along, as long as you show up to work, as I said, every year for the next 30 years, 25 maybe. Live within your means, budget, as I mentioned with the stuff, you will get there. And I know it's not sexy, what I'm saying, because everybody wants crypto, right? Everybody wants like, I put $100 and the price went up, within a week, like it's $150. Well, I need to invest more, right? That's sexy. What I'm selling you here is not sexy, because it's for 30 years. And no one thinks 30 years, first of all, is a long time, and they think they're going to win. That's why we all bet, right? But how many people bet and end up with the $10 million, right? The best bet is to sit there every day. I know it's not sexy, it's horrible actually. It's a life sentence, right? But the best bet is to sit there for 25 years or 30 years. You have a plan and you go, pay my home off, have a property at least under my name, have a property under my super fund, and when you come to retire, you've had all of these paid off because you are working on the numbers, and you are you're being disciplined. Yeah, there's no other way around it. But people still try to convince me that crypto is the right way, and I've had people, and I cry. I've had clients calling me this year, going, I put up 50,000. Now it's like 150. Yeah, but it's on paper. I'm gonna put another 200,000, borrow more money from the bank. And I say to everybody, only invest in speculative investments, money that you're willing to lose. So if I've got 10 grand set aside, and I don't care if they're in my account or not, I'll bet on that 10,000, but I will never borrow money on something that is speculative. Yeah, just steady she goes. You will see where that will take you. Yeah. Part of the service that we provide is that we find the properties for you. We work at the strategies. Some people, they can get more than, one property. But we work at the numbers, whether they've got enough money, whether they've got, enough capital, enough equity. All this is per person's circumstances. The other thing that we do when we don't, but the people that we refer our clients to, they do the research on where the properties are, the best properties in the market, and they look at what's the best value in terms of the economics and employment. As I said, you don't want to go and put invest in $120,000 property where you can't find a tenant. So all of these things get considered before they kind of say, look, these are the properties we recommend. The other thing is, and sometimes people miss, is consider land tax. So instead of having 2 properties in one state, split them over 2 states, because that way you can avoid land tax. So these are the limits. If, let's say, Queensland, you will start paying land tax for any land value above, let's say, Queensland 600, New South Wales 755, Victoria 250, South Australia 450, Western Australia 300. Actually, we didn't put Northern Territory or Tasmania. Hey?
Is there a reason why Victoria's threshold is so low?
Because they want more tax. They want more tax, yeah. So you could, this is the land value, not the property value. It's not the build, it's just the land. Yeah. And guess who determines the land value? The government. This does not include your own home. Like if you own your own home and it's like let's say the land value in New South Wales, let's say, is over $1 million, you don't pay land tax on your own home. This is on investment properties apart from your own home, and that includes holiday homes.
Is that a cumulative number or per property?
Cumulative. Yeah, land value total.
Okay. So if
Per
your
person.
profit is over 755 and stuff.
Yeah, you're stuffed. Yeah, yeah. Now, when we look at where people can invest, we're doing the can invest is we're looking at where people want to buy. So you got Generation Y, and you got baby boomers. Baby boomers downsizing. Generation Y want the lifestyle. They don't care. Okay, so we're whatever we look at for clients, it's to target those 2, not the students, not the holiday makers, but those 2 generations. Why? Because that's a growing population, and that's a growing population. There's a lot of people who want to live solo. They've had enough, you know. Relationships are not easy, especially if you got a very hard job. You can't cope with your boss and then come home and have to deal with the husband. Too hard, isn't it? But anyway, we look at all of that for clients. The biggest growing apartment living owners is baby boomers, because they're downsizing, you know, taking a bit of the cash because they have not saved for retirement when they were working. And so they do that. Plus, they want to stay in their area. They no longer want to go to Queensland and live there, and then, you know, they're sick and no one's looking after them. So they want to stay where the amenities are, where their lifestyle is, where their friends are. Yeah. So we consider all of that. So if you would like to come and see us, this is kind of stuff that we do for clients. We take you from the A to Z. We get you the loan, we get you the property, we get you the structures. Because what we are, we're determined, Wendy and I, to get our clients on the path. We still, I think probably we're halfway through that, to drill it in our clients for them to do something. We're halfway through with our clients. We have not captured everybody. People are bogged down with their careers or with things that are happening for them. But that's basically what we want to do. And the first thing I would recommend, let's get you money intelligent. Read the book, do the money courses. We're about to do an Invest Your Money course that's coming soon. Where to invest, how to invest in different areas like what we discussed today. We'll dig deeper in different areas. Profit Master Program is for business clients. And so, I'm doing all my best to educate people about money because it's my passion. I love this stuff. So if you want to come in and see me, I think it might take maybe like an initial strategy between 1 to 2 hours. So the fee would be $330 to $660. If you say, look, I think I'm not ready. I don't have a deposit. I don't have equity. I don't know what to do. I'm all over the shop. Let's get you on the Master Your Money course. That's online. I do coaching with that. So it's like, it's with a group no more than 8. I've done that with clients, but we're not doing that yet. Not till probably July that I would do like live with me, come and see me once a week. I used to do that online, but next one might be live, like in a meeting like that. Once a week people show up for the course, but not yet. But the online is just as good. It's just you won't see me here.